about the calculation of the price of a bond using the YTM. We'll also discuss about the yield to maturity and its assumptions. We'll also discuss about the relationship between the bonds, YTM and price, and the coupon rate. So let's start discussing about the price of a bond using YTM. So the price of a bond should be the present value of a promised cash flows of the bond. For traditional bonds like fixed coupon bonds, the promised cash flows are coupon interest payments and repayment of full principal. So coupon payments are periodic payments, and repayment of principal is made at the end of the maturity for a traditional bond. And the market discount rate is the rate of return required by the investor, given the risk of the investment in the bond. So if a bond is a bit more risky, then required rate of return is slightly higher. For government bonds, the required rate of return is relatively lower compared to corporate bond. So if we try to find the price of a bond, so the present value of a bond should be equal to all the cash flows should be discounted at the required rate of return, and we should sum all the present value, so then we'll find the price of a bond. For example, if we see this problem, this problem says that a bond having an annual coupon rate of 6%. So 6% is the coupon rate. The par value of the bond is 100, and the coupon is payable once a year. So this is an annual coupon payment bond. So the bond pays annual coupon. The maturity of the bond is 10 years. So if an investor buys this bond, they will get Taka 6 every year, and at the end of 10 years, they will get the par value of 100 Taka. The market discount rate is 7%. So what will be the price of the bond? So if we try to find the present value of the bond, so investors will get Taka 6 every year. So market discount is 7%. So first coupon is discounted at the 7% rate. Second coupon is discounted also at the 7% rate, 6 divided by 1 plus 0.07 to the power 2. This way it will continue up to year 10. On year 10, the investor will also get the principal payment of the bond. So 100 will be discounted at the 7% rate. So 100 divided by 1.07 to the power 10. So the present value should be equal to 92.98. This can be found easily using the Texas Instrument BA2 Plus calculator, or BA2 Plus professional calculator, where we use the time value of money function, where you will give the input n equals to 10, which means maturity of the bond. I by y equals to 7. 7 means 7%. So calculator automatically takes a 7. So never put 0.07. You have to use 7 for 7%. PMT is 6, which is the annual coupon payment, and future value is 100. Once we give all the input in our calculator, then we have to press CPT, which means compute, and then we have to press PV. So the calculator display will show 92.98 negative, because since we gave the input for PMT and future value positive, so we will receive the cash flows. For that, we have to invest the bond. So we have to, our present value should be negative. So we need to, we need not to bother about the negative sign. The present value is 92.98. So this way we can find the present value of the bond. So next concept is yield to maturity. So yield to maturity is the internal rate of return of a bond. So it is the uniform interest rate such that when the future cash flows are discounted at this rate, the sum of the present values equal to the price of the bond. Yield to maturity is also called the implied discount rate. So the investors, so when investors buy a bond, they have to pay the market price. So if the assumption is if the investor buy the bond and hold the bonds till maturity, the investor will get the face value of the bond, for example, 100 taka. Another assumption for yield to maturity is that the issuer does not default, which means the issuer makes all the coupon and principal payments on the scheduled dates. Another assumption is the investor will be able to reinvest that coupon at the calculated YTM. So if the investor buys the bond at the market, at the current market price, hold the bond till maturity, the issuer does not default, and investor will be able to reinvest it, invest the coupon at the calculated YTF, and then the expected rate of return or the realized yield of the investor is the YTM. So in practice, what happens, the realized YTM often differs from an expected YTM, because often the investor cannot hold the bond till maturity. Often they need the cash flow and they have to sell the bond in the market. So if they sell the bond in the market before the maturity, then the price depends on the then market discount rate. So that price might be lower or high depending on the how the interest will move in the future. Also, there are some risks that issuer might default. So investor might not get the coupon and principal repayment at time or by the full amount. The major reason why investor doesn't earn the expected YTM is the reinvestment rate. So interest rates are usually volatile. So when investors buy the bond and get the coupon, that coupon will be reinvested at the then market interest rate. So if the market interest rate increases, investor will be able to reinvest the coupon at the higher interest rate. If the if the market interest rate goes down, then investor will be able to reinvest the coupon at the lower interest rate. So we'll talk about in detail and have more calculation in future in the chapter understanding risk and return about the YTM. So we'll see how the realized YTM differs from expected YTM depending on the changes in interest rate. So let's try to solve this question. Here it is said that an Australian institutional investor owns a 5-year bond. The annual payment of the bond is 4% coupon, so coupon rate is 4%, and the par value of the bond is 50 million AUD. So since the par value of the bond is 50 million AUD, the annual coupon rate is 2 million, 50 multiplied by 4%. The bond's current price is 48.75. Question is, what is the yield to maturity of the bond? So if we try to solve this bond has a maturity of 5 years. So the investor is expected to get coupon payment of Taka 2 every year for the next 5 years. So in the final year, the investor will get 52. So if we discount this, all the coupon rates, all the cash flows will be discounted such a rate so that the price of the bond will be equal to 48.75. So if we try to solve this Y in a trial and error method, then the Y that equates the present value of all these cash flows equal to the 48.75 is the YTM. This is also called the internal rate of return. In the case of bond, this is called YTM. So we can, again, we did not use the trial and error method. We can solve this YTM using the Texas Instrument BA2 plus calculator. So using that calculator, we will give the input n equals to 5, present value equals to 48.75. Remember, we have to give this minus. So in order to give the input to the calculator, we have to first type 48.75. Then on the calculator, there is a button plus oblique minus. So if we press that, then we'll be able to see that in the display that 48.75 minus, then we have to press present values. Then we'll see present value equals to minus 48.75. PMT equals to 2 and future value equals to 50. So we have to press then CPT and press I by Y. The calculator will show that the YTM is 4.57%. This means if we buy the bond today at 48.75, hold the bond till maturity, we'll get 50 taka after 5 years. If we reinvest the coupon every year for the remaining maturity of the bond at the rate of 4.57%, our realized YTM, our compound annual growth rate of return will be 4.7%, 4.57%. Here, one thing we can see that the bond is priced at discount, and YTM is 4.57%, which is higher than the coupon rate. This will always hold. So if the price of a bond is below the par, the YTM is higher than the coupon rate. Alternatively, we can say if the YTM is higher than the coupon rate, the bond will be priced at discount. If the YTM is lower than the coupon rate, the bond will be priced at premium. If the YTM is equal to the coupon rate, the bond will be priced at par. So that's the relationship between price and coupon rate and the bond's YTM. So YTM is also called the market discount rate. So if the market discount rate is greater than coupon rate, the bond is priced at discount, like the previous example. If the bond market discount rate is lower than the coupon rate, the bond is priced at premium. If the market discount rate is equal to coupon rate, the bond is priced at par. So whether the bond is priced at par or priced at discount or priced at premium, usually determined by whether the market discount rate is higher than or lower than or equal to coupon rate. So when one purchases a bond, and if the market discount rate goes up, the bond price declines. If the market discount rate goes down, the bond price goes up. So there's an inverse relationship between the bond's price and yield. We'll discuss about that in the next LOS. Thank you for joining this lesson.